Pay attention to the market, not opinions. Hi, everyone. I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. I received a question to my bond trading service, Oxford Bond Advantage, asking if I was concerned about a particular bond that had a low rating from the rating agencies, even though the bond was trading near par value. Now, bonds are issued at $1,000, which is par value, and then they trade up and down until maturity when they are redeemed for $1,000. If a bond price falls, that could suggest that investors are losing confidence that the bond will be repaid. So I explained that Wall Street certainly didn't seem worried based on the bond's price, regardless of the low rating by S&P or Moody's.
You're focusing on the wrong thing.
Now, one of the best lessons I've learned in my investing career is to pay attention to price and ignore opinions. For example, prior to the Great Recession, the market topped in October 2007. Analysts were bullish at the time. Bear Stearns didn't collapse until March 2008, and Lehman Brothers did the same 6 months later. By then, the market had already fallen 30%. The market then bottomed in March 2009. The economy was hardly out of the woods yet. The day the market bottomed, the government announced that 651,000 jobs were lost in the previous month. That was on the tail of 655,000 in January of 2009 and 681,000 in December 2008, which was the worst reading since 1949. Not exactly a sign that the economy was getting better.
I'm okay.
Yet, it eventually stabilized, and the market's bottom suggested just that ahead of time.
You see the stock market today? Up, down, pick a direction, huh?
Same with the COVID crash. Now look, the market is not a crystal ball and it can't see every unexpected event, but after stocks crashed as the global economy shut down, they quickly rallied again, suggesting that our biggest fears, a global economic collapse, would not be realized. The market looks forward, generally about 6 to 9 months. So think about all the doom and gloom messages out there, and there are lots of scary headlines. Debt is out of control. Our president is the oldest sitting president in history and is running for 4 more years. As of now, his likely challenger has been indicted on criminal charges. America is perhaps more divided than in any time since the Civil War. Inflation is still high. War rampages in Ukraine. AI seems poised to take over the world, which is a very scary thought. The planet is heating up. Should I go on? Any one of these things could shake you to your core and scare the bejesus out of you, and they probably should. Yet, the market keeps rallying. The doom and gloomers say a market crash is coming like they always do. And once in a blue moon, they get it right. But most of the time, they just watch as stocks go higher like they do over the long term. Year to date, the S&P 500 is up nearly 14%, while the NASDAQ has gained 17%. Those numbers would be a pretty solid year for the market. It's telling you that despite all of the problems, it's going to be okay.
You okay?
I'm all right.
You all right? I'm all right. You all right?
Yeah.
You okay?
Fine.
When the market tops, that's the time to get concerned. For now, the doom and gloomers are going to be wrong for a little while longer. Thanks for watching State of the Market. I'm Mark Lichtenfeld, and for more wealth and income building ideas, be sure to subscribe to my free e-letter, Wealthy Retirement. Just click on the link in the description and subscribe to this YouTube channel. I'll see you next week.